Hi everyone. Thanks so much for being here. We're really excited to have Katya presenting and Tom discussing. Just to give you a quick logistics, it's going to be a 40-minute talk followed by discussion and then Q&A. There is going to be a chat, so go ahead and put any questions you want during the talk into the chat. And Katya has some co-authors here, Brian and Johan, and hopefully they can answer. Otherwise, we'll pause or we'll have room for questions at the very end as well. Finally, just a request, if you can, put your camera on, makes it a little bit more friendly and interactive. With that, take it away.
Thanks a lot, Melanie, for the introduction, and thanks a lot to all organizers for inviting us to present this paper. This is a joint work with Brian and Johan, who are here in the audience, and I'm going to talk about the informal startup financing today. And what exactly we mean when we talk about informal startup financing? Well, here we talk about, wait, did I forget to unmute myself? No, okay, sorry about that. Well, and when we talk about informal startup financing, we talk about the capital and equity coming from the family members. If we think about informal financing, it's quite a prevalent source of the entrepreneurial finance, especially at the earliest stages of startup life cycle, right? If we think about the economic magnitude, the most recent statistics show that around 5% of the firms receive some loan or equity investment from family and friends, as opposite to around 0.5% of firms receiving venture capital number, a number very close, that was one mentioned by Corinne Zarutsky in 2012. Once conditioned on receiving equity from family, the magnitude of equity is quite similar to what the startups receive from the owners as an equity. This is what an earlier paper Rob and Robinson showed. And the magnitude is way higher than the loan that the owners provide to the company. So, equipped with this importance, of this source of the early stage financing, we know relatively little about that. And in addition to that, the informal financing comes with a bit different set of economic predictions than with the other startup investors. If you think, for example, about the angel investors or VC investors, and I will talk in a moment why there is a different set of economic predictions here. But informal financing is supposed to be characterized with lower required returns. And startups and the entrepreneurs seem, or they're predicted to prefer the informal financing less than other forms of financing for various reasons. And it also results in the lower risk-taking behavior from entrepreneurs in the startups. So taking it from there, our research question is, what are the characteristics of informal investments, right? So how do the returns from informal investing look like? Do they make entrepreneurs take less risk? And what is the role of wealth in the informal financing? So if we think about the different mechanisms that are coming, with all those questions, the first question we're asking is like, why should informal investment returns be actually lower than other investments? And there might be different reasons for that. On the one hand, this is altruism, right? If my cousin needs money for her startup, then I'll just provide money because she needs help, right? On the other hand, I might think, okay, I'm seeing her regularly, and so, I have maybe a low information asymmetry than all other external investors. So I have lower risk here investing in the company, which would result then in the low return. But at the same time, I might be not as sophisticated and don't have such a financial literacy as any experienced investor. That's why I basically invest in a lower quality company that wouldn't have reserved any financing otherwise. On the other hand, when we think about why would entrepreneurs take actually less risks, here, well, on the one hand, it could be the higher monitoring. And I'm not only talking about the official formal monitoring as having the board seats or giving away the higher stakes in their own ownership, but actually, if I meet my cousin at the playgrounds when our kids play, I will definitely ask you how the business is going. So what's up? What are you up to? So do you have any milestones met, right? So the entrepreneur might feel like it's a bit more under this monitoring pressure. And on the other hand, you can also think about this as shadow costs, connected to the family financing. Because if I fail my startup, then I will have a lot of social obligations toward my family members. And I might ruin my relationship for a very long time. I am not invited to the Christmas party. Well, maybe I want it, but in any ways, the relationship will be ruined in this case. In order to somehow try to attempt to disentangle between these different mechanisms behind the informal financing, we differentiate between different groups of startups receiving informal financing. On the one hand, we have startups that receive financing from informal family members only, right? These are our informal firms. And here we expect the influence coming from the family members being the strongest. And if this influence is the strongest and we don't have any other investors there, right? Then this might result in the lower risk-taking of the entrepreneurs in these companies. On the other hand, we have startups that are financed both by informal family members, but also by the external individuals, right? In this paper, when we talk about external investors, we only talk about external individuals, such as angel investors, right? So we compare individuals being informal and external to the firm. And we expect here that this might be potentially higher quality startups because, if an external investor invests in this firm, and they know that there is another informal investor has invested who have actually lower information asymmetry, that might serve as a signal to the external investors, right? And the theory suggests that, the reduced risk-taking coming from the informal financing might be mitigated when we have two different sources of financing coming in. And then we compare those firms to the startup that are financed by the external individuals only, right? So we talk only about external individuals here. This is an empirical paper, and testing all those questions and predictions has been pretty difficult in the past due to data constraints. Well, on the first, how can you gain the information on all the startups with the financial information to assess the risk behavior, the risk-taking behavior? How should we identify informal investors? How do we observe their returns and measure their returns, in fact? And what we do here is we go to Norway, literally, and we'll take the Norwegian data. The great thing about the Norwegian data, and it's coming from two sources here that we use, is that Norway has wealth tax, which is great for us because tax authorities gather all information and the tax records on all equity transactions and shareholders by all investors in Norway for the entire population of all firms established there, right? And also the foreign investors have to submit their tax reports if they're invested in the Norwegian companies. And this information from tax reports, it has the transaction information, including dates, amounts, and number of shares. So we basically see how much everyone in Norway basically invests in what kind of firms. The tax records also have the names and addresses of all individual investors, which is a great thing for us, because it helps us to identify family members of the entrepreneurs. And in this paper, our assumption is that the family members share the last name with the founder of the firm. And yes, we're aware that it has some limitations because, a wife can have a different name than the husband's, or, if you think about in the English countries, speaking English countries, the name Smith, for example, the probability is there that there might be an external investor who shares the same name. So we work on the solutions here, but, right now, we don't have the exact family ties, and we assume that family members share the last name with the founder as of now. And we merge this information to the company registry data, which basically covers, again, the entire population of firms with all their financial information, which helps us to proxy for the risk-taking behavior here. Having this great data is actually not sufficient because, we cannot take only the firms that have received some family financing. and to compare them to some or all firms receiving non-family financing, because we will obviously be comparing family firms to something else. So this will be comparing apple to pear. So we just cannot, select on the financing and then compare these two sample of firms. So we have to come up with some solution where we look at the more homogeneous, sample of firms out of which we can then select on the financing. And what we do here is that we rely on the methods that I have developed in another paper, which is basically applying the insights from Andrews et al. To the Norwegian context. And here we identify growth-oriented startups from the time of their establishment. That means we take the entire population of newly established firms, which are potentially interesting, and potentially interesting means no financial services, no subsidiaries, no firms, fisheries, or the hairdressers, no tattoo, tattoo shops. So basically, we exclude firms that are operating of potentially non-innovative industries. And getting from this population of newly established firms, we look at the certain characteristics at the time of the incorporation, of the establishment of the firm, because Guzman, Scott, and all the co-authors, they basically claim that how you incorporate the company provides you the signal what you're trying to achieve with this company. So we can see this at the growth ambitions. And those flags we come up with here are English name or something like English sounding name, does not need to be necessarily a proper word, that the firm is located in an innovation hub, which is like the 4 major research university cities. And at the time of the establishment already, we have at least one board member who lives far away from the firm, meaning that the company needs some expertise from abroad. And if the firm satisfies at least one of these flags, we say that this is a potentially growth-oriented startup. So this is how we identify this homogeneous pool based on the ex-ante characteristics at the time of incorporation. Just quick validations of this sample. Well, around 90% of all VC-backed firms are actually in this sample, which is good for us. We show that each of this flag can actually predict future financing, either from VC or coming from the government. Each of this flag, either for itself or cumulative, can predict future patent application, M&A or IPO, and conditional on the survival of 4-year revenue growth. We show that more than 90% of the overall private capital in Norway is actually flowing into those companies, into these 46,000 companies. And, and it doesn't matter how we play around with these flags, because one might say, well, why do you take one flag? Why do you take 2 flags? Why do you take the innovative industry and not the other flags? So if you see, it doesn't matter how we play with these flags, and this graph shows you the timeline of the valuations of all the startups based on different definitions of this sample. If you look at the, above 4 lines, they're pretty much the same. So we are pretty confident that we can work with this ex-ante sample of potentially innovative firms. Any questions so far? Should I have a look in the chat, or are my questions?
No, you're fine. You can keep going.
Okay. So out of these 46,000 of growth-oriented startups, we identify 4,500 of firms that receive some informal financing, so around 10%. And almost 16,000 firms out of those receive some external individual financing. Interesting is that informal investors invest in the earliest stages, right? This is how we probably have expected. And approximately 70% of all first informal investments are made just around the incorporation of the firm. So this is, this is complementing the insights that, you have the owner's equity, you take the owner's loan, but there is also more capital coming from your family who help you establish the company. Not even 40% of external investment happen around the incorporation or in the first year, and the distribution of, and the fraction of the distribution is more smooth than for the informal investments. So informal investments come into the firms way earlier, well, not way earlier, but at least 1 year earlier than external investors here. In terms of the industry distribution, we do not observe any significant outliers here. Well, if we look at the IT, the largest fraction of external finance firms is there, followed by the informal and external, and the lowest fraction is at the informal only. But at the same time, if you look at the R&D, like the largest fraction here is by the informal only firms. And in terms of all the other industries, we don't observe any significant any significant differences here. So I think we are fine when it comes to the distribution of operating industries here. So coming to the description of the equity investments, to the fund parts and to the returns. And when we look at these descriptive statistics, the first thing that we observe is that 35% of all external investments are a total loss, but it's almost 50%, like 47%, if we look at the informal investments. And because of the higher fraction of the total losses, we also observe a lower distribution of the TVPI in the informal investments compared to the external investments. Well, on median, it's almost the same. You see that we have right skewed right tail, and that's why on average, you know, an external investment earns twice as much, while the informal investment is only 1.5 times on the invested capital. Because we see that the informal investors invest early in time, so the holding periods might be different here when we think about the TVPI. So we also look at the monthly IRR, and we still observe the same pattern that the returns from informal investments are actually significantly lower than from the external investments, actually to a higher extent than TVPI, which could be also be driven because of these total losses. Because if we have a total loss, we assume an IRR of -100% here. These are the realized returns. And when we talk about the realized returns, you know, it can be driven by the purchase side of the transaction, and it also can be driven by the realization side of the transaction, meaning that the informal investors might realize their investments differently than external investments if it's driven by the liquidity constraints, or maybe it's easier to squeeze out family members than any external angels, right, if the new investors are coming in. So to make a statement about the returns, we also look at the unrealized returns here. Basically, we are, you know, taking the most current share price observed in the firm, and then basically we only look at the variation in the purchase side of the investments. And here we see a bit different picture, right? In the median terms, the investments in the external and informal, from the returns from external and informal investments are pretty similar. And only the right tail of the informal investments are actually way higher than that of the external investments. And this tells us that the lower realized returns are not driven, you know, maybe it's an indication, right? And it's indicative that, you know, the lower returns are not driven necessarily by the selection into the firm, not necessarily only, but also by the way how investors realize their returns. When it comes to the investment characteristics, well, we have seen that the firms are younger when informal investors come in. Owners and the founders give more ownership away to the informal investors than to the external investors, and they give more often the board seat, because 74% of the informal investments have a board seat in the firm, in comparison to 40% of the external investors, which is also indicative a bit of this monitoring story here. When we look at the investors, then we observe that they're a bit younger. The informal investors are a bit younger than external. We have more women there, but at the same time, the investors are less sophisticated in the term that the percentage of public stock investors is lower, and we have less repeat angel investors there. At the same time, family members are less wealthy than, you know, external investors, which talks a bit, you know, about this altruism story here. But we want to test formally if informal investors realize lower returns indeed. So we estimate the following, estimate the following regression model where we take our TVPI or IRR as the dependent variable, and we regress on the dummy if it's an informal investment. We're here on the investment level, at a bunch of investment and investor characteristics as shown here, and basically look at the difference. The loading is strong, statistically strong and high in the magnitude, implying that, again, informal returns are lower by 74 percentage points than the returns from the external investments. And it still holds the same magnitude if we include calendar year, firm fixed effects, industry fixed effects, region fixed effects, or even if we include investment firm age fixed effects, because we know that informal investments happen earlier in time. But if we look at the variation within the same year, then informal returns are still lower. So of course, we also want to have, or you have some taste, if there is any firm selection going on here or not. So we try this in column 7, and we basically look at the variation within the same firm. So how do informal returns differ from the external returns if investors invest in the same firm? And the magnitude drops, but we still observe a negative coefficient here, implying that informal returns in the same firm still lower than that of their external. And we want to test maybe, different type of people, different sophistication levels. Maybe, people just have different skills. So what we do in column 8 is we include investor fixed effects, and we basically look at the informal investments and external investments made by the same individual. The coefficient is negative. It's not statistically significant, but when we look at the monthly IRRs, we observe that there's significant a relationship is still there. That means that the investors, if they make an informal investment in comparison to them making the external investments, they realize lower returns. Questions so far? Melanie, is it going?
Yeah, maybe actually I'm in the middle of writing a question, so I'll just ask it while we're here. How should we think about, for column 8, like selection into family investors who invest multiple times? Like, should we think of that as like an unsuccessful entrepreneur who tries and tries again and their family invests in them multiple times? Or are these entrepreneurial families with lots of investors? So just kind of thinking about who are the family investors who could have an investor fixed effect.
Yeah, I mean, so because we only include one fixed effect by the time, right? So we are not talking here about the multiple family members investing like in the same firm. Look at the multiple firms. So there still can be some selection who invests where. So we are trying, we cannot make any statement here about, this clan investments of the same, in the same firm or taking multiple investments. Here we actually look at the first investment only made by the individual, just, to make it a bit simpler at this point. So I don't have an answer to this question because we are not looking at this here.
Sure.
Yeah.
Actually, related to Melanie's question, so what's the average number of firms like a family investor invest in? Like, what's the variation? So,
how many firms? I mean, how many?
Because like it seems that in the previous slides, like the investor fixed effect takes away all the effects. So,
yeah,
is it because they don't invest? They invest basically in only one firm at a time, and like a family, like I don't know, like your family may not have that many investment opportunities. I mean, and that could also inform what is your channel. So is it like to help, or is it like really, do they really expect some returns? So
yeah, we haven't looked, in the detail into, what, how many firms and how this happened, what's behind those. I think the reason why we included this here was basically only, at this stage, right? Only to try to disentangle this sophistication angle from anything else without trying to claim any other, answer here. We just haven't looked at this yet in detail. This is a very early version of the paper, where we just trying, to get, if it's from the selection, trying to argue. I mean, the selection is still there, obviously, you can see it, right? One, we include the firm fixed effects, the magnitude drops, but it's just, we are trying to identify if there's something else going on than just, the selection here. But so these are great points. We need to look into this deeper. So in order to understand in more detail what's going on here and why the returns are lower here, we turn to the firm level sample, to the firm year level sample here. And in the first stage, at the first step, we analyze whether informal startups have a lower probability of receiving any institutional sophisticated finance. I mean, this doesn't really go into your direction, Camille, but just, something that's, try to say something if they couldn't receive any other financing or if they could receive financing. And what we indeed find is that the probability of receiving institutional financing, of sophisticated financing in the year when we have an informal shareholder is significantly lower in the firms with only informal financing than in the firms that are only external financed here, right? So we have the lower probability of having repeat angels, we have a lower probability of having venture capital, any established corporate investor or any foreign investor here. At the same time, when we look at the subsample of firms receiving informal and external financing, then the probability and the odds of receiving, the repeat, all the type of institutional sophisticated financing is way higher here than when the financing received only by the external finance firms. So if it connects a bit to your question earlier, then, it depends, right? If we have, only informal financing, then yeah, you're right. It seems like the odds are lower to receive any, better capital. But at the same time, we have this another type of firms which works through a different channel, apparently, that if we have informal and external financing in the firms, then they have higher odds of receiving this institutional financing. And so this informal financing is not just the last rescue that they could have. Another way to look at this is that we look at and we analyze how informal startups have a lower probability or higher probability of different exit events. So we basically want to know how do they behave and, which direction are they aiming towards, And again, if we look at the informal finance firms only, the odds are way higher that they do not experience any exit event at all, right? So the odds of having the bankruptcy filing, the official bankruptcy filing is just the same as in all other firms. But at the same time, the ceiling is way lower here because the probability that they experience an M&A on IPO is way lower than in the external finance firms. So they just, there's not a lot of volatility there. They just continue operating still independently. Nothing happens a lot here. On the other hand, if we look at the firms that receive both informal and external financing, again, we do not observe any differences in terms of the bankruptcy filing rates, but conditional ongoing bankrupt, these firms actually survive for a longer time than the external finance firms. And it could be, we don't know it yet, it could be due to the informal investors being there and trying to prolong, the period, or maybe these are higher quality firms, that are able to survive for a longer time without filing for the bankruptcy, or they receive, any additional financing here. We don't know this yet. At the same time, they have, again, higher rates of M&A and IPO in comparison to the firms that receive only external financing. So this speaks, that the informal finance firms, could have, a bit, less risk-taking behavior because, they do not strive for higher exit, they do not take higher risks, as opposite to the firms receiving both types of financing. Which leads us to our second question, which we try to, look at it, in a more formal way, and if informal finance startups take less risks. So we take 4 proxies for risk-taking behavior, which is the profitability, the ratio of intangibles to total assets, the total patent applications, and 1-year revenue growth. And we basically run this baseline OLS regression where we, estimate the effect, well, not the effect, we estimate the correlation between the informal dummy and the dummy on informal and external financing and our different proxies for the risk-taking behavior. What we find is that informal firms are associated with a higher profitability, less intangible assets, less patent applications, and lower revenue growth, which is indicative of just taking less risks in those firms, because we want to have, a more solid profitability. Well, it's still negative, right? We're not talking about positive profitability here. It's a negative profitability, but it's higher or less negative for those firms. Those firms seem to innovate less and they grow at a slower rate. At the same time, we observe the completely opposite effect for firms receiving both types of financing, informal and external, where we have a lower profitability. At the same time, they innovate less and they grow at a higher rate in terms of revenues. Of course, we do not claim anything here. This is baseline results, and this could be due to the different type of firms and the selection, again, into different type of financing. So what we do next is we take one small and tiny step towards, towards the causal direction. And we use an instrumental approach here, instrumental variable approach. And we instrument our informal financing dummy with the average distance between the startup headquarter location and each individual's investor residential address. So basically, we look at the distance between where the startup is located and where the investor actually lives. And we expect and we find a strong negative first stage relation, because family investors are likely to live together or in a similar area with entrepreneurs, so that the beta 1 has then a statistically significant negative coefficient here. More important, and this is the exclusion restriction, and the way we think about it, that the shareholder startup distance only works through this informal investor indicator, which then affects the startup performance. Of course, one might argue, well, there are some unobservables that might affect, the startup selection, so that, and they might affect, this distance at the same time as the performance, right? So that the low quality startups may just look after investors who live close by. They're not famous, they have, no publicity, so they only take, look at the investors who live close to them. If this is the case, then this would apply not only to the informal investors, but also to the external investors, right? But this would also mean that if we have lower quality investors coming, from the informal side, then if these are the firms with a lower quality, then they should also have a shorter distance also to their external investors, right? But this is not what we empirically observe here. On the one hand, we see that in the external investors only firms, we have 2.6 external investors on average, while on the informal by external investors, we have 7 external investors on average. And the average distance between those external investors is 70 kilometers, for the external investors only firms, which are presumably of a higher quality, in comparison to the 95 kilometers between external investors and presumably lower quality startups. So, we would have expected different results, the opposite results here. But in fact, the mean distance between external investors and startup headquarters is actually higher in the firms where we have also informal financing. One might argue, it's everything's the matter of the capital access, so the distance might be less of an issue in, let's say, Oslo, where we have a good access to the capital, but it's, it's more important in the rural area So in the robustness checks, we basically take the subsample of the startups where the distance, is less of the concern, basically the startups who are in Oslo only, and the results are robust. I have been talking for a long time. So the second stage, estimations basically confirm our results. And we see in the second stage that informal firms have higher profitability. Again, they innovate less and grow at a slower rate, while informal and external rates, again, and the coefficients in the magnitudes are even higher here, and they are more statistically significant here, even after adjusting the standard errors, because the F statistic is relatively low here. We still observe the same results as in our baseline regressions. We conduct a number of the robustness checks here, and for example, we restrict our sample to external-only finance firms, where we have only external investors, which are informal investors somewhere else. So we are basically only comparing the firms selected by the same individuals, right? And the results remain the same. We also test a different IV, which is the investor inheritance. And we look if the investor receives any inheritance 1 to 3 years before the investment. The logic behind it is that if an individual received unexpected large amount of money, then the investor might be, or the family member might be more willing to give it to another family member than they wouldn't otherwise. The results remain the same, but the F statistic is even lower here, indicating that this instrument is even weaker than what we use here. Turning to the last question, we explore here is what is the role of the investor wealth here? On the one hand, wealthy investors might have more investing experience, and they might resemble the angel investing behavior, and that's why the founders and entrepreneurs might take even more risks when they receive money from the wealthy individuals. But on the other hand, the wealthy investors are a bit more risk averse. And this risk aversion might translate to the entrepreneurs if shadow costs are higher in wealthy families. If the ties in the wealthy families are actually higher, then I would be more carried away to undertake any risks and lose the money. So what we do here is that we rerun the analysis we have done before. But in addition to the informal dummy, we also include a dummy if an individual is an above median wealth individual. And we include an interaction term between if the individual is an informal investor and if this individual is a wealthy individual. The main effect on the informal dummy resembles everything what we have shown before, right? So the same effect, the same direction, the same similar magnitude here as the baseline results. The main effect on the wealth indicates that wealthy individuals are actually willing to take more risks in the startup context. Basically, they're more, like acting like, these are the angel investors, basically, if you think of Bach et al. Paper, because, the profitability is lower and they innovate, or the coefficients on the intangibles and patent applicants is basically higher. But the interaction term of our interests, and it's basically the same, and it doesn't matter which samples we compare here, is the informal and wealth interaction, which indicates that informal wealth is associated with less risk-taking. Because it doesn't matter if we compare informal finance to external finance firms, or if we compare informal and external finance to external finance firms, we also observe the same effect of this interaction term. And basically that we observe a higher profitability and less innovation potential, which are both, associated with less risk-taking behavior. So to conclude and to summarize, this is an early version of the paper, and we examine characteristics of informal investments and investors. We find and we demonstrate that informal investments have low returns. firms that are financed by informally only, they are linked to lower risk-taking behavior, while firms receiving both types of financing show some stronger risk-taking behavior. Our risk-taking results are supported by our instrumental variable approach and bunch of robustness tests. And we also provide evidence that informal wealth is related to lower risk-taking behavior, so informal wealth. We have a lot of next steps for this paper already now, so we are looking forward to your comments, feedback, and to your discussion, Tom. But we are going to test an alternative IV in the future. We want to document better the shadow costs. We want to pin down the effects of the wealth on the informal financing and on the firms, and in generally conduct more cross-sectional tests here. So thank you so much. And if there are any questions, I don't know what's the right, if to ask them now or after Tom's discussion.
Let's go ahead and Tom's going to give it. Thank you, Katja. Tom's going to give a discussion, and then we'll have some time for Q&A at the end.
Yeah, thank you. Looking forward to it.
Thank you.
Thank you. So, Katja, can you stop sharing so I can take over?
Sure.
Let me see. Do you see my screen? Fantastic. Okay, so thanks very much for the introduction and for inviting me to discuss this paper. So let me see. The clicker, it's not working. Okay, let me see. There we go. So I'm not going to spend a ton of time summarizing the paper. Katja did a very fine job of doing exactly that. So this paper studies the return of family investors and the impact of these types of investors on firms. And the authors find that family investors on average, they earn lower returns than other investors. And they have some impact on firm behavior through, for example, proxies for risk taking. So overall, I think the topic is very interesting. The data are very cool. The paper is nicely executed. That said, I now have the fantastic privilege in our profession of being able to propose a ton of ways that the authors can improve the paper without actually having to do anything myself. So this is beautiful. Now I'm going to start out with some comments on measurement and identification. And the first comment is quite basic, and it concerns how the authors identify family investments in the paper. So let me just start by summarizing exactly what the authors currently do. So I see there's been a few changes to the paper since the version I have, so there's going to be a few caveats. But let's say we have a founder who has the last name of Hansen, and this guy is going to be represented by this red guy all the way to the left. Okay. So if the other shareholders in this company are called Jonsson or Larsen as the last name, this firm is going to be labeled as an external firm in the sense that it does not have any family investors. Okay. Alternatively, if this founder Hansen is joined by another Hansen as well as a Larsen, that firm would then be labeled as informal external, as these two Hansens are assumed to be related, but this poor guy Larsen is not part of the family. Finally, if the firm consists exclusively of people who have Hansen as the last name, the authors are going to label this firm as informal. Okay, so the key assumption underlying this entire classification is that anyone that has a shared last name are going to be part of the same family. Now, I'm going to preface what I'm going to say now just by emphasizing that, we Norwegians, of course, we are extremely smart and brilliant in many ways, much more so than the Swedish people, of course. But we are not very creative when it comes to picking last names. Okay, so just to illustrate this point, I've compiled a list of the most common last names in Norway, and a few facts stand out. So first of all, 1.7% of all Norwegians, of the entire population, are called Hansen. Okay, so this is based on data from Statistics Norway. The second fact is that 12% of all Norwegians have one of 10 last names, and 21% have one of 30 last names. This name concentration that we observe in Norway is just significantly higher than what we observe in the US, which is what I tabulate on the right-hand side of this table. And it's likely higher than in other more heterogeneous populations. So the name data from the US are taken from the US census back in 2010. So, there's potentially a time gap. So, this is not perfect, but in Norway, we are not very creative when it comes to names. So what does this mean? So just to get a sense of the nature of any potential measurement error in this paper, I calculated the probability that a given company, just by random chance, will have at least one shareholder called Hansen. Okay, so we strip away all other last names, and we just focus on Hansen. So if we start out with a firm that has exactly one shareholder, the probability that that shareholder is called Hansen is simply 1.7%. Okay, so this is the probability that any given Norwegian is called Hansen. As we increase the number of shareholders, the probability that at least one of these guys is going to be called Hansen is, of course, monotonically increasing. Now, we can do exactly the same exercise for the probability of observing at least 2 Hansens. Okay, so when there is one shareholder, of course, the probability of observing 2 Hansens is 0. Okay, but as we increase the number of shareholders, the probability of observing at least 2 Hansens is going to increase considerably. So for a firm with 100 shareholders, there's going to be a 50-50 chance that there are 2 people called Hansen just by random chance. Now, so the problem with this is that the firm is then going to be labeled as external informal. So the key challenge, there's going to be 2 key challenges. So first, we're going to have just a meaningful amount of measurement error. Okay, there's going to be very, very many people within the sample that are not actually part of the same family. But perhaps the most serious concern is that this measurement error is going to be mechanically related to the number of shareholders in the company, which in turn can correlate with returns and other firm outcomes. Now, for each of the problems, I tried to have a solution. And the solution to this, I think, is quite simple. In the register data, we observe family ties. I have a very early stage work in progress where we link families back to the 1920s. So, I'm quite confused why the authors don't use this information. In addition, using these family ties that we have in the register data is going to force the authors to take a stand on what they mean by family. For example, a spousal investment certainly, at least to me, seems like a very different type of investment than one made by a second cousin or an uncle. Okay? So my point is going to be that we can use the register data to measure these family investments much, much better. Now, let me just stress that we will still have some potential issues when it comes to this current classification of investments. So just to illustrate my point, recall that investments are currently classified based on whether the firm has only family investors, no family investors, or some mix of family and other investors. So let's just go back to the probability of having at least one Hansen investor for a given number of shareholders. As we established earlier on, the more investors we have, the higher the probability that we will observe some sort of mix between Hansens and other investors. What does this mean? Well, it means that we are going to expect to find more external informal firms among firms with more shareholders. By contrast, when do we expect to observe the two extremes, namely firms that have all investors that are called Hansens, or all investors that are called something else than Hansens? Well, just probabilistically, we are going to expect to observe those firms where we have fewer investors. So the fewer investors, the more likely it is that they are either all Hansen or no Hansen. Okay, and I think we see this in the data. So in table 1, the authors compare the different types of firms. And while they don't present statistics on the raw number of investors in each firms, they show a measure of ownership concentration. And what we see in the data is that the firms that have a mix of Hansens and non-Hansens have the most dispersed ownership, likely because these firms simply have many more investors. So to recap, we have some key potentially mechanical differences between the different types of firms and investments. And this is going to bring me to the identification part of the paper. So in short, what the authors currently do is to compare the returns of family investors, these Hansen guys, to the returns of other investors, using some variation of this OLS specification. Now, this OLS specification is going to crucially make two different types of contrasts. The first contrast is going to be between the returns of this Hansen guy to this Larsen guy within the same firm, but also between this Hansen guy and this Johnsen and this Larsen in a completely different firm. Okay, so we are going to be comparing returns across different firms. This is potentially problematic, as these firms are going to be mechanically quite different, as I tried to establish in the previous few slides. And while the authors currently control for a wide range of firm and investor characteristics, including a linear term of ownership concentration in this vector X, if we want to make some sort of causal interpretation, we are then now placing just a tremendous burden on this vector X for this vector X of observable characteristics. Now, again, I want to emphasize that I tried to find solutions, and I think there exists a very easy solution. And I think this solution has currently been implemented by Katja et al., which is fantastic. Basically, instead of comparing across firms, I think the authors can focus on within firm variation. Just by expanding the OLS regression with this μj term, which is just a firm fixed effect, we're going to be restricting attention to firms where we observe both an external investor and a family investor. When we do this, just a very simple tweak, we are going to effectively mitigate any concern that external, informal, and mixed firms are just quite different. Okay? Based on the new coefficients that I saw today, this is going to reduce the coefficients by about 80%, which means there is some clear firm selection in play. But I do kind of think that this is the direction that the authors should be going in. Now, for these types of regression, where is the variation going to be coming from? Well, for the return regressions, we are going to then be relying on differences in the timing of investment within the same firm. So we are no longer making any comparisons across firms. We're basically saying we have two different investors investing in the same firm, just at different times. Do they earn different returns? To me, this sounds like a fairly credible specification. When it comes to the firm regressions, you could compare outcomes in event time before and after the entry of a family investor, and then contrast this to the entry of external investors. Now, looking at figure 1 in the paper, it does seem to me that you do have quite a bit of variation in the timing of family versus external investments. So this kind of makes me suspect that the reason why you, at least in the version I had, didn't include firm fixed effects is that this sample of informal external firms is quite small. So in the version I saw, it was about 1,500 different firms. This leads me to my third point. So currently, the authors restrict attention to a set of assumed innovative firms. to me, it's not entirely obvious that the benefits of doing so are going to outweigh the costs. And just to illustrate my point, I've included the front page of the Wall Street Journal from last Monday, so exactly 1 week ago. Okay, so on top we have a picture of SpaceX and its recent success when it comes to catching a Starship booster midair. Now, this is extremely cool and sexy, and I think what the authors are trying to do is to focus the analysis on these types of firms, which I totally understand. But let me now just draw your attention to the article just below, which emphasizes that in the US, we currently have private equity pouring just tons and tons of dollars into HVAC, plumbing, other types of extremely boring company from an innovation perspective. The point I'm trying to make is that firms don't have to be sexy to be economically important. So I know that some people are just completely obsessed when it comes to innovative firms. Okay, so this is just my personal preference. But if I were you, I would include both these innovative and the other firms in the analysis. This is going to give you two benefits. First, you're going to then be able to explore heterogeneity across innovative and non-innovative firms. There could be some interesting story that we can spin based on this. But secondly, if you include a bigger sample, you're going to be able to estimate your firm fixed effects regression on a much larger sample. Okay? My concern initially was that the reason you didn't do the firm fixed effects was because you didn't have a sufficiently large sample. So that's just the caveat from reading an earlier version of the paper. Now, I see that I am running out of time very, very quickly. I won't even have time to finish up half my comments. So I will wrap up, and I'm happy to discuss more afterwards. Just to summarize, I think the paper is very interesting. The data are excellent. The analysis is well executed. I think if the authors can just tighten up some key measurement and identification challenges, this paper will make for a very nice contribution to the entrepreneurial finance literature. Thanks again for inviting me.